Let's kind of shift more broadly here. Economic data out of the U.S., China, and the Eurozone have surprised recently, with GDP from the U.S. and Europe growing more than expected in their respective second quarters. For the world's second largest economy, things are mixed, with July manufacturing PMI beating estimates while remaining contracted and the services sector missing expectations. In an effort to help stimulate the economy, China's top economic planning agency, they released policy this morning focused on removing government restrictions on consumption. So what do these efforts say about the global economy? Let's put that question to our guest, Mona Mahajan, who is the Edward Jones Senior Investment Strategist. So what does this say about what they're actually seeing within the economy in China, which was said by the IMF at the start of this year to be one of the two nations that would contribute the most to global GDP growth, and in the face of what has actually played out in it kind of lagging or being lackluster compared to expectations?
Yeah, this has been kind of a curveball that nobody saw coming at the beginning of the year. There was a lot of enthusiasm and optimism as China reopened from its lockdowns. And really, a lot of that has been a disappointing reopening. And we're seeing that play out in the economy, the PMI numbers we just received, but also broadly, consumption and economic growth has come in below expectations in China. Now, perhaps, the one silver lining or hope there is that we are starting to see the Chinese government and really the central bank move pretty rapidly to provide some support and stimulus. So, of course, the Chinese central bank is one of the few major central banks in the globe that is moving in the other direction. They're cutting rates rather than raising rates like the rest of the global economies and global central banks. And also, we're starting to see more talks about stimulus being provided to a lot of the state-owned enterprises there and a lot of the regional businesses as well. And so we do think while the Chinese economy has stumbled a bit through this reopening process, the stimulus measures are now being put in place. And we do think over the next, call it 2 to 4 quarters, we'll see stabilization in China and probably a resumption of some, healthier growth patterns. So if anything, probably setting itself up to be an interesting opportunity broadly. But thus far, the Chinese economy being weak has weighed not only on the Asian region, but Europe as well as a pretty big trading partner for China. So we've seen their growth, probably not be as robust as it could be because of some of the weaker growth in China as well. So, broadly speaking, we do think that we're probably at a trough type level in China, probably going to see better data ahead of us. But it is, going to require a little bit of patience over the months ahead. But thinking about that from a portfolio perspective could be interesting, especially from an EM trade.
Mona, what's also interesting is you mentioned that the effect that it's having elsewhere in Asia and on Europe, it seems to have had less of an effect on the United States, right? Yes, we have had some U.S. companies that have said that China growth has been lackluster, but largely our rally's been just fine, right? So I wonder if things do improve there, just like the downside has not affected us that much, will there be much upside here from upside there?
Yeah, it's a good point. The U.S. is a bit removed, actually, from the Chinese economy than really it has been in recent history. It's not a large trading partner. And of course, we're hearing more about onshoring and moving away from the Chinese supply chain and manufacturing as well. That will take some time, but that is a direction of travel. So to your point, the upside that comes from the Chinese economy stabilizing and moving higher, probably more felt in the Asian and European regions, and probably will be reflected in those markets as well. So, we do think more recently we've seen the MSCI EFA, for example, non-U.S. developed markets and EM lag the S&P 500 and, of course, the NASDAQ broadly. But as we go through the next few months and we think about inflation globally coming down, we think about a stabilization in the Chinese economy and a recovery, Europe and even the U.S. over time, maybe going through some sort of soft patch and recovering from that as well. Mm-hmm. That's a good setup for global investments broadly and EM in particular, especially if in that environment the dollar continues to soften a bit. And so what we'd say is when we think about a recovery basket, we talked about cyclical stocks, we talked about small cap stocks. We would certainly include some EM and international exposure there as well. We do think the environment is setting up for a better recovery play in the 12 to 24 months ahead.
Interesting stuff. Mona, thank you so much for spending some
Thank you,
time with
guys.
us this morning. Mona Mahajan is Edward Jones Senior Investment Strategist. Thanks.